Gong Hei Fatoi, my dear REIT investors. In this week, we're going to preview two important REITs, that is Mlt Logistics Trust and Suntec REIT, before they announce their results towards the end of this week. As usual, do actually like and subscribe our channel as we bring you the latest, the most intriguing, as well as the most in-depth when it comes to real estate investment trusts. So do like and subscribe to our channel as well as possibly attend our investment classes. So for the first one, ladies and gentlemen, Mlt Logistics Trust. Throughout the whole of last year, as you can see from the chart, it has been a laggard stock. For those who have been attending our REITs quarterly investment classes, you notice it's one of the REITs that will single out that will actually underperform through 2021 and 2022 as actually interest rates increases. As you can see from the chart, once again, this REIT has fallen close to 25% in the course of the last 1.5 to 2 years. Now, why is that the case? And what do we expect from this coming results? Well, take a look at this again. This is the results from the last business update. You can see, ladies and gentlemen, that gross revenue were up 11%. NPI was up 10.8%. But the most important metric to a shareholder, that is you and I, the DPU only grew 3.5%. Once again, it exemplifies the problem with Mapletree Logistics in the sense that all along they have been doing a lot of accretive acquisitions across all markets from Malaysia, Singapore, Vietnam, and new markets like India. But what has it actually generated? Well, double-digit growth. Good for the managers who are actually earning fees, management fees, when they actually acquire assets at 1%. You, the shareholder, you and me, do not get to participate or enjoy this. In fact, as a matter of fact, when they actually do their acquisitions, as in the case of the last 5 years, they raise close to about $6 billion. Most of the time they issue new shares. And if you are actually not smart enough to actually have subscribed to their various placements at high prices, you notice that you have lost money in the last 3 to 4 years. So in this coming set of results, what do you expect? Now, of course, it'll be great for once. The DPU grows faster than the NPI and the revenue. Do I expect that to happen in this business update? I don't think so, man. The other reason why we have been successful in avoiding Mapletree Logistics downtrend for those who attended our REITs investment classes in the course of the last 1.5 to 2 years is this. Now, take a look at this chart, ladies and gentlemen. You notice that the revenue spread and asset management under management for Mapletree Logistics range from 20% in Singapore for Mapletree Logistics, but outside of Singapore, what do we have? We have Hong Kong, 23%, China, 21%, Japan, 10.7%, South Korea, 8.2%, Australia, 8.2%, Malaysia, 5.1%, Vietnam, 2.6%, and India at 1%. Now look at how these currencies have performed. Now, it's essentially because the Hong Kong dollar is pegged to the US dollar. It has not actually depreciated much as compared to the other currencies. But what has happened? You look at China renminbi is down close to 10%. Japan has been one of the worst G7 currencies underperformance versus the current Singapore currency, down almost 30% in the course of the last 2 years. Korea down 10-12%. Australia down roughly about 15-18%. Malaysia, as you can see, the ringgit has actually fallen from 2.7 to 3.3 as we speak in the course of the last 2 years, and Vietnam as well. So we can see, ladies and gentlemen, yeah, you go on acquisition binge, but at the end of the day, did the acquisition binge bring in the dough? Yes, you may have acquired good assets, but if these acquired assets will actually bring in revenue in depreciated currencies, who suffers? Yes, ladies and gentlemen, the shareholders of the Logistics Trust. And of course, at GCP Global, we actually help you to avoid this because we highlighted this to you 2 years ago because the profile of Mapletree Logistics AUM and revenue has remained the same in the last 2 years. So in this coming results, do you expect any change? No. So not surprisingly, ladies and gentlemen, just again look at the price chart. It seems that essentially the after falling close to 25% in the last 2 years, the price probably have hit the bottom at about 140 or 138. Closer towards the October lows, as we have highlighted in our investment classes as well as actually our write-ups. Yes, please go to GCP Global website because we actually give you an archive of the articles that have been published. They're published every month for the last 33 years. And right now it seems that Mabel 3 Logistics is forming a symmetrical triangle. Will this symmetrical triangle break? Will the share price then break up on the upside or low side? Well, it's something that we'll discuss in our class in detail on the 25th of February. Of course, noteworthy that this video is going to be like 10 minutes. There's no way I can discuss in detail on Maple3 Logistics Trust. So for those of you all who are actually interested in Maple3 and Maple3 group of family of REITs, which have delivered all this while, but in the last 2 years, they apparently has come to a standstill. So what does it mean for shareholders or potential shareholders of Maple3 Logistics Trust? Well, do join us for our class on the 25th of February. Do sign up now because you get to enjoy the early bird special. It will be held at the Hilton Singapore Orchard. We are grateful that the OU Group is the venue sponsor for our event. Now, as you can see in our classes, ladies and gentlemen, these are actually the various lunches that we have with the various REITs CEOs. Now, the first one on top is Capital Land China. The second one, as down below, is actually with Mr. Vincent Yeo, the CEO of CDL Hotel Trust. And then the next one is actually Miss Antia Lee, the CEO of Capital DC REIT. As you can see, ladies and gentlemen, what we do is that we actually meet these CEOs of the respective REITs regularly. It's been like that for already a few decades. And then we share with you the key important insights. Of course, during the lunches and the meetup, the CEO is not going to tell you anything exciting. Okay, but if you know your numbers well, if you know how to put two and two into one to five, that's how we actually shared. This comes under the CFA Mosaic theory, and so far this has helped us withstand the resilience and the profitable times in helping us to make millions in our REITs, as what my book Making Your. So once again, ladies and gentlemen, the upcoming results, as I was interviewed in the Business Times, actually says that it's very pivotal for REITs. Yes, it's very pivotal because, it actually exemplifies whether the bottom that we saw in October of last year, just 2 months ago, is the bottom or the false bottom, something that we'll discuss in detail in our class on 25th of February. So do join us and enjoy, sign up now to enjoy the Elizabeth special. Now let's move on to the second REIT in today's analysis, and that's Suntec Investment Trust. You can see, ladies and gentlemen, Suntec owns offices in Singapore, and they have recently expanded into Australia and London and the UK, rather. But look at the terrible underperformance. Now the rate line actually is Capital Land, integrated commercial compared to Suntec. So you can see that over the course of the last 5 years, Suntec is down 36%. Ooh, so the dividends that Suntec has been getting for paying out in at 5 to 6% for the REIT investors is not even sufficient to make up for the capital loss. So can you imagine if you have the wrong REIT in your portfolio, you notice that you are on the route to be losing money. Whereas compared to Capital Land, for the same 5 year period, yes, it's down 3% when the market's actually down. But with the dividend that you have gotten about 5% every year for the last 5 years, you would have posted positive total returns. So what actually is the problem with Suntec? Something that we have shared with, again, our investor students in our various investment classes 3 to 4 years ago. One is the fact that just take a look at this. Okay, now we have warned about this, and has happened now in this last financial year. Yes, look further. The DPU at 2.084, this was actually in the third quarter of last year, is actually down 6.6%. But look further, ladies and gentlemen. If you look at DPU from operations, even down even further, it is actually down 15%. So if not for DPU from capital, you notice that it's to make up for the shortfall from DPU from income, then you actually have an awful fall in the DPU payout of Suntec. So why buy into a REIT when the core operation is delivering negative returns quarterly after quarterly? Now, what is actually happening to Suntec and what has actually caused this? Well, one of the reasons is what is highlighted over there. As you can see, the round circle actually looks at the capital management. Now, capital management of this REIT is very interesting. Now, in a period when interest rates started to rise last year, Suntec has been and it still is one of the REITs with the lowest fixed interest rates borrowings at less than 60%. They are only probably behind Fraser Centrepoint Trust. Most of the REITs actually have fixed borrowings, going into the interest rate upcycle from 17 March last year, in the region of between 60 to 80%. And Suntec is actually very has actually made itself very susceptible to rising interest rates because the fixed amount of borrowings is less than 60%. Hello, doesn't higher interest rates actually scare you? And how is it that shareholders are not prepared for that? Now, the second point, ladies and gentlemen, is that let's again look at the uh, distribution income and the DPU. Yes, it's actually down. In fact, it's actually down even more. Distribution income is down 5.8%. DPU is down 6.6%. Now, do you expect this to reverse in this coming quarter, in this coming set of results towards the end of the week? I don't think so. So are we going to get more of the same or same of the more? Okay. Now, the second aspect that's very important for Suntec, ladies and gentlemen, and we'll see further evidence in this set of results, is the Australian aspects. You notice that Suntec has always been telling you that, hey, let's go overseas to expand because Singapore, the assets are limited. After all, the portfolio in Singapore is all restricted to assets in Suntec City itself. They are positioned in Park Mall, which surprisingly they actually own 30% or have sold, and a few other very, very mini assets, whereas so they actually expand in Australia. And what happens? Because when operations are down, blame it on the currency, blame it on the economy. The GPU in terms of the net property income is actually down at awful double digit 13.8%. In our classes, ladies and gentlemen, when REITs post negative double digit drop in DPU or NPI is a serious problem, which is something that we have picked it up, months before and years before, a severe drop. And that's why you notice that the severe share price erosion continues. Okay, so in Singapore dollars term, it's actually down even worse, almost 20%, as you can see, ladies and gentlemen. So in the last quarter, you ask yourself, has the Australian dollar actually gone up or stabilized? Well, it's at 1.085, down from roughly 1.03. Yes, it's actually each up from the bottom at 1.11. So what does the next quarter holds? What does it beholds? Should you still be in Suntec REIT? Considering the fact that the share price underperformed, has actually reached a plateau. Considering the fact its book NAV is 210 and the share price currently is below 140, is a discount sufficiently large now to attract value investors back? Well, it's something that we're able to discuss in detail in our classes. As you can see in our classes, in the next one on 25th Feb, you see a lot of happy faces, a lot of gray hairs, white hairs. Yes, that's because the bulk of our students are ultra high net worth individual investors relying on REIT income. So it's very important and imperative for us to find you only good REITs that will give you stable income without other side effects. That is basically expansion in the wrong market at the wrong time, following a Australian dollar impact on its portfolio and whatnot. Okay, so as you can see, ladies and gentlemen, this is what we do at GCP Global. Hope you like this week's video. Smash subscribe to the like button and find out more. If you want to actually have a good resilient growth in your REITs portfolio by signing up for our class on the 25th of February. Once again, happy Chinese New Year and Gong Hei Pat Chai.